Many folks are now starting to realize they might not be able to retire when they want to. That's because they haven't really planned out their retirement. So if you're looking to start or even update your retirement plan, then this video is for you. Today, we'll be talking about retirement planning mistakes you need to avoid. Before we begin, make sure to subscribe to this channel for more videos just like this. Mistake number 1. Quitting your job. Throughout their career, the average worker changes jobs about 12 times. Many make this switch without realizing they may be missing out on valuable employer contributions like those to their 401k plan, profit sharing, or stock options. This is all tied to vesting, a concept where you don't fully own the funds or stock your employer contributes until you've been with the company for a specific period, often around 5 years. Before deciding to leave your current job, it's crucial to check your vesting situation, especially if you're close to the deadline. If you're approaching vesting, it's worth considering whether to leave those contributions behind when making a job change. Mistake number 2. Not saving now. Harness the power of compound interest by starting to save now. Every dollar you save grows over time until you retire. If you are just starting out your career, start investing in your retirement now. The sooner you start, the more money you will compound over the course of your working life. Time is a crucial ally for compound interest. The longer your money accumulates, the more it benefits. Prioritize saving by trimming expenses. Experts recommend allocating at least 10 to 15% of your total income to retirement savings throughout your working life. If your employer offers a 401k, contribute as much as possible. These contributions are oftentimes pre-tax, reducing your taxable income for the year. The interest and earnings also grow tax-free until you withdraw them in retirement, when you'll pay income taxes on the distribution amount. In 2024, the IRS allows a maximum 401k contribution of $23,000 per year, with an additional catch-up contribution of $7,500 for those aged 50 or older. In the absence of a 401k, consider a traditional or Roth IRA. However, be aware that you'll need to save more since there won't be matching funds from your employer. For 2024, the maximum annual contribution to a traditional or Roth IRA is $7,500, up from $7,000 in 2023, with a catch-up contribution of $1,000 allowed for individuals aged 50 and older, making the total contribution limit $8,500, up from $8,000 in 2023. Mistake number 3. Not maxing out a company match. If your workplace hooks you up with a 401k, jump on board and go all in on your contribution, especially if they're offering that sweet employer match. Usually, it's a slice of your salary. So let's say you're putting in 6%. Your boss might match with 3%. It's like getting free money. If your company's match game is strong, it's basically cash falling from the sky. Just know there's a cap set by the IRS for the total contributions, both from you and your employer. In 2024, it's $69,000 or $76,500 if you're 50 or older and making the $7,500 catch-up contribution. Back in 2023, the limit was $66,000 or $73,500, catch-up contributions included. So make the most of that match while staying within the IRS rules. Mistake number 4. Not having a financial plan. To keep your retirement on track and not end up broke, make a plan that thinks about how long you'll likely be around. Consider stuff like when and where you want to retire, your health, and the kind of lifestyle you're aiming for. Once you've got a plan, don't forget to give it a refresh now and then as your needs and lifestyle shift. And hey, it's not a bad idea to chat with a certified financial planner to make sure your plan really fits you. Mistake number 5. Investing unwisely. When it comes to investing, make savvy choices, whether you're dealing with a company retirement plan or navigating through traditional Roth or self-directed IRAs. Some folks lean towards self-directed IRAs for the flexibility in investment options, which can be a good call, but just be cautious not to jeopardize your savings with risky moves, like going all in on speculative tips such as investing heavily in Bitcoin or super high-risk options. Now, diving into the self-directed investing world might feel like stepping into a classroom, so it's smart to have a reliable financial advisor by your side. Steer clear of shelling out hefty fees for underperforming, actively managed mutual funds. That's a no-go. And if you're thinking about the self-directed IRA route, make sure you're ready to truly take the reins on your investments. For many, a safer bet lies in low-fee exchange-traded funds, ETFs, or index funds. Keep an eye on your 401k disclosure, too. Your plan sponsor has to spill the beans annually on fees and how they can nibble into your returns. So give that document a read. It might unveil policy or fee tweaks that could sway your investment game. Mistake number 6, not rebalancing your portfolio. Keep your investment portfolio in check by adjusting it at least once a year. This helps to stick to the mix of assets you're aiming for, adjusting as market conditions shift or retirement gets closer. As retirement approaches, it's wise to dial down your stake in stocks and up the portion invested in bonds to align with your changing risk tolerance and goals. Mistake number 7, poor tax planning. If you anticipate being in a higher tax bracket during retirement compared to your working years, consider putting your money into a Roth 401k or Roth IRA. With this approach, you pay taxes up front, but all your withdrawals, including the earnings on your investments, are tax-free. On the flip side, if you expect lower taxes in retirement, it's smarter to go for a traditional IRA or 401k. This way, you dodge high upfront taxes and pay them when you withdraw the funds. Be cautious about taking a loan from your regular 401k though, as it could lead to double taxation on the borrowed amount. You'll repay the loan with after-tax dollars, and your retirement withdrawals will also be taxed. Mistake number 8, cashing out savings. If you decide to cash out part or all of your retirement fund before hitting 59.5, be ready for your plan sponsor to withhold 20% for penalties and taxes. This means you won't get the full amount, and you might struggle to catch up on future earnings. Be cautious about leaving less than $5,000 in a company account when switching jobs without specifying what to do with it. Your employer might toss it into an IRA for you after taking a 20% cut, resulting in high fees that could eat into your savings balance. If you're planning to move money to another qualified retirement account, remember you've got a 60-day window before taxes and penalties come knocking. To sidestep this, you can opt for a direct rollover or trustee-to-trustee transfer, avoiding the 60-day rule. To prepare for healthcare costs in retirement, consider boosting your savings in tax-advantaged accounts like a health savings account or HSA. This allows you to cover qualified healthcare expenses in retirement without paying taxes. Mistake number 9, driving up debt. Piling up debt before retiring can put a dent in your savings, so it's crucial to maintain an emergency fund to steer clear of last-minute debt or dipping into your retirement savings. It's a good idea to aim for paying off or at least reducing debt before you retire. However, financial experts advise against halting retirement savings to pay off debt. Finding a way to do both can bring greater benefits. Mistake number 10, don't overlook planning for healthcare costs. According to the Fidelity Retiree Healthcare Cost Estimate, an average retired couple aged 65 in 2023 might need around $315,000 saved after tax for healthcare expenses in retirement. Taking steps to stay healthy can lower this figure. Remember, Medicare doesn't cover all healthcare costs in retirement, so consider getting supplemental insurance or be prepared to cover the difference out of pocket. Mistake number 11, taking Social Security early. Delaying your Social Security filing can boost your benefits, with the maximum potential reached at age 70. While you can start filing as early as 62, the full retirement age is typically 66 or 67, depending on your birth year. If you can, it's advisable to wait until age 70 for maximum benefits. However, if your health is not in good shape, waiting might not be the best move. Additionally, if spousal benefits are a consideration, filing at full retirement age might be a smarter choice. This way, your spouse can also file and receive benefits under your account. So, what are you doing to avoid these mistakes? Let us know in the comments below. If you enjoyed this, please give it a thumbs up and subscribe to our channel for more personal finance and investing related content. Thank you for watching this video on retirement planning mistakes you need to avoid. Here's to becoming rich and financially free.